I'd like to welcome you to our inaugural webinar, Experience Options Like Never Before, a monthly 7-part series which will give viewers an exclusive opportunity to learn about a variety of topics related to options from industry experts at the Cboe. I'll be asking Cboe experts about their presentation, their professional lives, their views on various options topics. You, the viewer, will also get a chance near the end of the webinar to ask questions. So make sure to watch the entire show. I wouldn't want you to miss anything. The educational presentation should be about 15 to 20 minutes, followed by questions for about 45 minutes total. This webinar series is part of a broader collaboration between Moomoo and Cboe that includes several in-person events and the introduction of index options on the Moomoo platform last November. Today, I would like to welcome Andy Bevers, Vice President and Head of Derivative Account Coverage from Cboe Global Markets. Andy's been involved in trading his entire career, including getting his start on the floor of the Cboe as a floor broker. The title of his presentation is Building on 50 Years of Options Innovation with the Cboe. Andy will discuss the history of exchange-traded options, talk about the different products, their increasing popularity, the trends in the industry, and what the future might hold. Before we begin, make sure to go to moomoo.com/US to check out our current sign-up promotions if you haven't been a client already. Welcome, Andy.
Hi, Justin. Thanks for having me. Appreciate the opportunity to present. So yeah, like Justin had alluded to, I will kick things off with a presentation, add some context around Cboe and how our markets are evolving, and we'll transition that into the next segment, which will be the discussion between Justin and I. So again, Andy Bevers, I am a vice president at Cboe. I'm the head of the relationship management side of the exchange. Effectively, the way that my team is situated, we own the relationships with all of the primary order flow providers that transact on our markets, and specifically the US derivatives markets, options, and futures. And then we segment the team across client segments specifically. So Vince Seco is the retail, responsible for the retail engagement. From that perspective, obviously Justin and the Moomoo team are very familiar with Vince and all the good work that he's done in establishing the partnership between Cboe and Moomoo. So with that, I'll jump into the presentation here. I'll start with a quick overview of Cboe, kind of the history of the exchange, how we established ourselves. Obviously founded as the first US options exchange in 1973. We do have the exclusive licensing agreement with, we have 3 primary index provider relationships, S&P, FTSE Russell, and MSCI. So we do have the exclusive listing rights to the products across those index providers. When we talk about the S&P agreement, licensing agreement, the SPX and VIX product suite is probably top of mind with everyone, and certainly the I would say the highest profile of all the proprietary products that we offer. So SPX and VIX give us the opportunity within that licensing agreement to create very bespoke contracts and product offerings. When we talk about SPX, obviously we have the standard SPX, the standard SPX option contracts. We also do have a mini SPX contract, symbol XSP, 1/10 the size of the standard SPX contract. We have an S&P ESG contract. So again, highly correlated to the standard SPX contract, but accounting only for the ESG qualified underliers. When we talk about VIX, VIX kind of spans the gamut across our Cboe primary options listing exchange, as well as CFE, our futures exchange. So we do list the cash settled VIX options on Cboe, our main options market. On the CFE side of things, from the futures perspective, we do offer VIX futures as well as mini VIX futures, similar to what we do with SPX and XSP, 1/10 the size of the standard VIX futures contract. When we talk about the evolution of the SPX and VIX product suite, a next product launch for us will be towards the end of this year into early next year. But it will be a physically settled VIX options on futures contract that will be listed exclusively on CFE. So again, the last point I make in this slide, right, the deep relationships and shared commitment with industry partners to expand investor education and access to options trading, that kind of encapsulates the mission of us as an organization. Education has obviously become an increasingly important consideration for us, and we'll certainly get into it a bit more later in the discussion. But Options Institute is the education arm of the exchange, and we'll get into some of the considerations with respect to what they do specifically. When you talk about Cboe as an organization, we've, I think that we'll acknowledge that we've had, I would say, a brand awareness issue that we've looked to address from the marketing perspective. I think inevitably, when people think of Cboe, they think of obviously our main options market, where we establish a presence and a name for ourselves. But the truth of the matter is, we truly have expanded across regions, jurisdictions, and asset classes. So we do operate in 16 locations across the U.S., Europe, and APAC. We operate 26 markets across the globe. Obviously, in the U.S., we operate 4 options exchanges, Cboe, and our 3 fully electronic options medallions, C2, EDGX, and BZX, as well as across the regions and jurisdictions that we operate in, equities markets, FX, crypto, an ever expanding group of product offerings. All of that is to say that we very intentionally, from the marketing perspective, rebranded our marketing slogan to Cboe, the exchange for the world stage. And we feel that adequately and appropriately reflects the breadth and scope of the expansion of the organization across, again, regions, jurisdictions, and asset classes. On to the next slide, we'll start digging into some of the content and considerations across what we see across the industry, the entire U.S. options industry. So annual options volume here to start. As you can see from the inset, right, there are currently 17 options exchanges that function in the U.S., soon to be 19. So MIAX Sapphire and MEMX will be launching a second exchange later this year. But when you talk about annual option growth and the trends that we've seen with respect to that, 2023 total option volume was up 7.65%. To a record annual volume indicated on the slide of 11.11 billion contracts. So you can see that there's pretty significant and an increasing adoption of options. If we look at the industry trends, right, starting back 1973 when we launched, volume was slow to build. Everything was executed on the floor in open outcry. It wasn't only Cboe, Amex, Philly, Arca also operated physical trading floors as well that started and launched after we did. So adoption was fairly slow to build from that perspective. But the real impetus for the explosive growth that we saw was around 2000 when ISE came into the mix. They were the first exchange to come to pass that was fully electronic. And that really forced a sea change within the industry that caused other electronic exchanges come into the mix. So those would be the exchanges 5 through the balance indicated on the inset there. And again, that was really the driver for access, growth, and further adoption of options across the industry. So Cboe was, again, floor-based, exclusively open outcry trading. We did transition at the time, shortly after ISE, to a hybrid model. So we allowed for access to our markets, both open outcry or electronic. So a couple of different flavors and some flexibility around access to the products that we list and that we trade. Moving on to the next slide. Average daily option volume broken out by index, ETF, and single equity volume. Again, if you look at the ADV, right, we're trending upwards of 50 million contracts a day. And again, the trends kind of speak for themselves, right? A lot of growth, explosive growth coming out of the pandemic, attributable to retail in a lot of ways. But that's where we really started to see that explosive growth around the single name equity options. Again, so knock on growth with respect to ETF and index options as well, right? So the inset here, if you take a look at the trends, 1 year, 5 year, 10 year, kind of speaks for itself around what the growth has been across those subsets. But it's been interesting to observe, to say the least. Average daily option volume by product for the index side of things. Important to note here, SPX accounts for 71% of the total index option volume across the industry. On any given day, we transact upwards of 3 million or more contracts in SPX per day. There's been a lot of growth from that perspective over the past few years, specifically with the introduction of Tuesday and Thursday expirations into SPX, which Justin and I will get into that a little bit more after the presentation. But really adding that level of granularity and flexibility with respect to the offering is, for all intents and purposes, doubled the volume within SPX over that time frame. So it's been really interesting to see. And again, we're always trying to be open and receptive to client interest. We're obviously very client focused and engaged in that regard, and it's really important for us organizationally to ensure that we're focused on the needs and feedback with respect to those that are transacting in our markets and in our products. So we're always receptive to open and receptive to new potential product offerings that may make sense, and where we think there's a fit and an opportunity for the overall market. Moving on to the next slide. This is an interesting one, right? It talks about trade size and how over time we've seen, certainly over the past few years specifically, a decrease in the average order and execution side, right? So interestingly, the bottom half of the slide, the daily option volume has increased substantially. The average order and execution size has interestingly decreased quite a bit. I think that's generally attributable to two considerations, right? First and foremost, a lot of this flow gets broken up algorithmically. What I mean by that is there's a lot of kind of systematic flow that gets submitted through an algo, and you may have a larger overall order that's going to be executed over the course of the day, but it does get broken up into smaller pieces over that time horizon. The second consideration is directly attributable to the growth that we've seen in retail, right? The obviously the true retail considerations lead to situations where the average order size is smaller than we had typically seen, and I don't think that's unexpected or surprising to anyone, but an interesting observation from that perspective. On the market structure front, we'll talk briefly about the entire industry, the U.S. Options market industry. So what you'll notice here, there are 6 primary exchange families. Each of those exchange families operates a number of medallions or exchanges. From the perspective of Cboe, C1, as we refer to it, or Cboe, our primary venue that I mentioned previously, our only hybrid model, hybrid exchange, I should say, trades both electronic and open outcry. C2 is our fully electronic pro rata make take exchange. BZX is our fully electronic price time make take venue, and EdgeX is our kind of classic pro rata customer priority venue. So all of those different flavors, what you'll see here and what you'll observe is, generally speaking, every exchange has considerations for those different market models. And when we talk about those different flavors, right, they incentivize different pockets of order flow and different client segments specifically, which is why, generally speaking, all of the exchange families have kind of situated themselves in that way. The other thing that you'll notice, interestingly, that was reflected on the previous slide as well, there's certainly more demand and interest for physical trading floors. So MIAX, one of the venues that was typically fully electronic with the primary MIAX, Pearl, and Emerald venues. They'll be launching Sapphire, another electronic venue, later this year, but they are going to be opening up a physical trading floor. Box opened up a physical trading floor as well. So an interesting observation from that perspective, but that's just kind of the way that the U.S. derivatives and options market specifically has been evolving over time. When you take a look at the breakdown by volume by operator, so again, all of those venues and considerations kind of consolidated in order to give a graphic depiction of their piece of the pie. Cboe stands at the top of that group. Obviously, our proprietary index products create a situation for us where we have accretive volume in those products that the other exchanges don't have access to. And then there's an additional breakout just to the left of that one that gives further context around the actual breakdown of each of those individual venues specifically. This slide speaks to the client segments, right? So you have market makers, liquidity providers, obviously the firms that are responsible for quoting all of the products across the various exchanges. So the interesting trends here, right? The firm side has stayed flattish over this span of time, 2011 to 2024. There's obviously been pretty significant growth beginning in, call it, 2019, 2020 from the customer, the retail side. That's also kind of mirrored growth on the market maker liquidity provider side, and that makes sense, right? Typically, what you'll see is that the market makers will be the contra side to the customer liquidity. Not always the case, but generally speaking, that tends to be the trend. We'll speak here quickly about 0DTE option volume by market share and by product. So these are all of the products that have 0DTE options listed, meaning Tuesday and Thursday expiries and expiry every day of the week. So SPX, this slide's a bit misleading just because it's based on notional value. When you look at the actual volume, SPX is far and away the largest volume product with respect to 0DTE, but when you break it out on a notional basis, it skews that a little bit. But I guess the next thing I would note, first and foremost, RUT. We in January listed Tuesdays and Thursdays in both the Russell 2000 standard Russell 2000 index options, as well as our mini Russell contract MRUT, which is again similar to XSP, 1/10 the size of a standard RUT contract. So I think the question that we get asked a lot with respect to this stuff is, where is there an appetite for further expansion of 0 DTE or Tuesday, Thursday daily expirations? Does it eventually expand outside of the index space? I think that remains to be seen. We'll always be receptive to opportunities to expand where we think it makes sense to do so responsibly, and where there's opportunity. And we'll kind of gauge client demand, and we're always keeping a close eye on the metrics from that perspective. One that's kind of more catered towards Moomoo specifically, estimated retail broker activity. If you look at the combined ADV of the overall market versus the combined market share of all those retail platform providers, you can see that it trends somewhere around 50 to 60%. So a lot of interest from our perspective on drawing a bead on the percentage of volume from the retail broker platforms that is directly attributable to retail. Those waters get muddied a bit, just because I think when you talk about the retail platform providers and the largest retail platform providers, there are a couple different flavors of that, right? You have traditional retail, and you also have a term that's kind of come into the lexicon lately, protail, which is effectively sophisticated retail or quasi-institutional retail. So breaking it out between those considerations, it's a bit more difficult for us to draw a bead on and ascertain. But at the end of the day, the retail adoption, retail growth across both equity, ETF, and index options is really the trend and the story that we've been drawing a tight bead on of over the course of the past couple of years. Gazing ahead, where do we go from here, right? How some of these considerations will work themselves out, and where there are opportunities. I think when you talk about extended hours there at the top, we do offer overnight trading of our proprietary index options, so XSP, SPX, and VIX. And we've seen good growth in volume from that perspective. We're always on the policy front looking to introduce potential efficiencies to financing and the cost of carry and trading and whatnot. So to that end, protected options noted here is a pretty interesting one for us, right? So effectively, we did receive regulatory approval earlier this year in order to recognize margin offsets between the associated ETFs and our proprietary index products. So those will be recognized. We think that there's a real opportunity for further growth, adoption, and expansion across our proprietary products, given those margin offsets and the capital efficiencies that they'll introduce to the marketplace. Beyond that, right, new trading floors, expansion of VIX, proprietary data, some new strategic initiatives from our perspective, new product offerings, the SPX, which is our dispersion futures, which will be launched next year, quoted spread book, cross product spreads, all the functionality, market structure, and product initiatives that we take into account and look to move forward and to ensure that we're being innovative and responsive to customer demands, and really offering our clients with as much flexibility and choice with respect to the way that they deploy capital as we can possibly look to do. So with that, that concludes my presentation. I'll stop sharing from that perspective and bring Justin back into the mix, and we can kick off the fireside chat.
Great presentation. Lots of great information there. So we're going to get a chance to ask Andy a bunch of questions about his presentation and his experience. And then you, the viewer, will also get chances to ask him some questions. So please keep those questions coming in on the chat. We won't be able to get to them all, but we will choose a few and get to them near the end of the presentation. So first, Andy, I just wanted to talk to you a little bit about how you got started in the industry and kind of what your story is and how you came to be where you are.
Yeah, no, appreciate you asking. Interestingly, so I graduated from high school in the late 80s, dating myself a bit there. I knew that I wasn't in a spot where I, would have been successful with transitioning directly to college. So did a bit of self-reflection from that perspective. Actually made the decision to enlist in the Marines. So I did a tour in the Marines. Once I'd completed my commitment there, I actually applied to college. I was accepted. I had one summer to get through before the new school year began, and needed to find something to occupy myself with over the course of that summer. So I have a twin brother that was on the Cboe trading floor he was a clerk in the OEX, the S&P 100 options. He suggested that I come down to the floor and give it a shot and see if there was any opportunity there. It was an interesting time, right? There was the ability to get onto the floor and to get involved in the business was pretty unique. I mean, he got me on the floor. I literally walked booth to booth, firm to firm, and engaged with with the heads of those firms and asked them if they were looking for anyone, if they had any opportunities. I did find a firm that right out of the gate was like, hey, we are looking for someone. We're actually looking for someone immediately. Can you start tomorrow? And I was like, I don't have anything going on. I'll be there. Right. So I did start with that firm. Started out as a runner, as everyone does. Quickly over the course of that summer, worked my way up
And so
to
what is a runner? Just not every.
Sure.
Yeah, I just
Yeah.
wanted to
So
just stop you for a second, and not all our viewers totally understand what happens on the floor, so we want to get a little bit more granular on and also ask you about the jacket you're wearing today. I know a lot of the people down on the floor wear jackets with very colorful schemes, and just can you tell us a little bit more about being a runner, what that means
sure.
versus being a trader, and why the crazy jacket?
Yeah. So context around that. So you effectively had three flavors of roles from the perspective of the floor at that point, right? At least from the trading firm perspective or the executing firm perspective. So a runner was kind of in introductory kind of way to get into the business. So you would have desk clerks that were engaged with the clients and actually taking order flow from the clients. Those they sat on the desk, obviously, right? And those orders needed a means to get from the desk out to the broker or into the trading pits. So the runners would be the ones that would take the orders from the order desk either to the floor broker of that specific firm or to the crowd broker, whatever the case may be. The order clerks or the desk clerks were the ones that would they'd be responsible for actually engaging with the clients providing the order flow. So they would provide market color, they would take the orders, and they'd engage with the trading pits, the market makers, liquidity providers, the floor brokers in order to transact those orders. And they'd be the ones responsible for end of day processing and all of those considerations as well. Then the floor brokers, every crowd had a floor broker that was dedicated to the products that traded in that particular crowd. And then generally speaking, every firm had their own floor brokers that would transact flow on behalf of the clients of that firm. So over the course of that summer, I started as a runner. Within, I want to say it was a matter of weeks, I moved onto the order desk and moved onto a seat by the end of that summer. I'll take a quick step back and address your question around the trading jackets. Probably not as prevalent today as they used to be. We actually don't even require them on the floor any longer. But back in the day, it was really kind of a way to differentiate one firm, the employees and the representatives of one firm or one market making group versus another. And to your point, Justin, they did get pretty loud and obnoxious, and the more attention you could draw to your jacket, the more attention you could draw to your firm, right? So these are
Yeah, you must
the
have. Do you have any crazy stories about the floor? That anything really interesting that happened during your experience there, or if you've heard from other traders and market participants?
probably not a ton that's appropriate for this venue, but there was a lot that happened, on the floor. The good, the bad, and the ugly. I mean, you see a little bit of everything. I would say that it's evolved to a situation where it's much more buttoned up and professional than maybe it was back in the day. But it's certainly come a long way from that perspective, to say the least. So.
No, very, very interesting. So yeah, I do want to ask you a little bit about what trading was like pre 1973, and what really precipitated the need for an options exchange, and what are some of the advantages of trading on an exchange in person versus over the counter?
Yeah. So it's interesting, prior to the exchange launching in 1973 as the first listed options venue, right? Transactions and options were handled and priced manually by put and call dealers, effectively early days OTC trading for all intents and purposes, right? So it was, as you would imagine, it was quite labor intensive and inefficient. In order for a client to put on a position, they need to get in touch with one of the put and call dealers within that community, that network, in order to quote and price the trade and see if there's interest in order to put on a position, and then again to liquidate a position too, right? It was pretty labor intensive and inefficient from that perspective as well. So really opening the exchange allowed for more transparency, more efficiency, the concentration of liquidity from the floor community, and also standardization of expirations and strikes, right? So it was really an effort to kind of streamline all those considerations.
Oh, that's very interesting. And thinking about where we are today, one of the most popular products is SPX. Can you tell me a little bit more about that? Was it a big hit from day one? Did it even exist on day one? And what has led? What was the recent surge in popularity? Why?
Yeah. So yeah, Cboe listed options on both the S&P 100, the OEX, and the S&P 500, the SPX, on July 1st of 1983. On that date, 350 SPX contracts traded on that first day. Interestingly, for the first few years, the S&P 100, the OEX, was really where we saw the majority of the volume concentrated. Over time, more and more of that volume kind of migrated from the S&P 100 to SPX, the S&P 500. Specifically after the crash of 87, and then it really accelerated in the early 1990s, where the SPX really became the widely accepted benchmark, leading indicator of the broader U.S. stock market for investors. So that's really how that growth, transition, and expansion has evolved over time.
Yeah, that's very interesting. And I know a lot of the growth is coming from zero DTE options. And one of our users actually has a question about that. And generally, I just want to paraphrase their question. And they want to know if this increase in zero DTE trading is on the retail side? Is it on the institutional side? And then also, what are you seeing in terms of the reasons? Is it mostly speculation or hedging or something else? Can you talk a little bit about those topics for a question from one of our users?
Sure. Yeah. The reason and the growth has been it's been fascinating to observe and to have right direct line of sight and visibility as that whole trend has evolved over time. But it's been zero DTE has been the real story and driver for growth over the course of the past few years for us. It really started with institutional client demand specific to SPXW and a desire to offer daily expirations, given that there's an news event or economic number being released every day of the week. So additionally, on top of that, I think the ability to hedge across different time horizons and avoid carrying overnight risk are all contributing factors to short dated demand. We certainly didn't anticipate at the time that we'd see the level of explosive growth that would come as a result of listing Tuesdays and Thursdays in the SPX complex, but it's certainly unanticipated considerations with respect to the interest in options trading that came from the retail client specifically is one of the main drivers of the growth that we've seen certainly over time. Last month, for example, our total SPX volume was around 3.4 million contracts per day, and around 1.7 million contracts of that volume is directly attributable to the SPX contract expiring on that day. So it's half of the SPX volume at that point, which again represents the lion's share of the growth that we've seen in the SPX over the course of the past few years. So like I mentioned in my presentation, right, that growth has caused us to look into other opportunities to expand to Tuesdays and Thursdays across our other proprietary index products. Like I noted, RUT and MRUT at the start of this year, but we'll certainly keep an eye towards other potential opportunities where we think there may be a fit in order to expand the short dated listings.
That was a great question from our user, and keep those questions coming in. Another one of your very popular products is the VIX. And a lot of investors have heard about the VIX being a fear index, but it's much more than that. Maybe you can give us a little explanation for our listeners and viewers as to what the VIX is, what does it measure, and why would you want to trade it?
Sure. I mean, at its core, right, VIX measures the expectation of stock market volatility extrapolated by options prices, and specifically the S&P 500 index options. So rather than measuring realized or historical volatility, VIX projects implied or forward-looking expected volatility, specifically 30 days into the future, by measuring changes in the prices of options on the S&P 500. So really, the VIX made volatility an understandable number, right? It's translated it into a number that's easy to digest, easy to understand, easy to keep a measure on. Again, to your point, it was later dubbed the fear gauge, which captured the public's attention, turned it into a global benchmark. But yeah, I mean, I think volatility is an asset class, is something that certainly we're always looking to lean into and to expand the complex and expand VIX across other products and look to expand the ecosystem.
Yeah, so VIX is another area in volatility generally that our users on the Moomoo app can look at and use various tools to help them understand that. Hopefully, our viewers are able to download the app, check it out, and check out the tools we have to analyze volatility. Another question I got from a couple of different users, and again, it's the broad topic that I'm interested in, is they're kind of asking what a market maker is. And particularly, I think they're interested in, is there a difference between market making for derivatives or options than maybe just an underlying security? Can you talk a little bit about what market making is, and then specifically what market making for options is, how that might vary a little bit.
Yeah, happy to. So effectively, as a listing exchange, right, we provide the trading platform, we create the products, but as an exchange, right, we don't provide quotes or liquidity in any of our products. So we rely upon the dedicated market maker community and the liquidity provider community in order to provide that function, right? So without those strategic partnerships, which are certainly some of the, if not the most important relationships that that we handle here at the exchange and that we have here at the exchange, right? We don't have good, tight, and robust liquidity on the screen, which is in a lot of ways the strongest advertisement for us as an organization, the products that we list. As far as how market makers differ from the option side versus the equity side, right? There's really not much difference there. The way it typically fleshes itself out is that a market maker firm will apply to become a registered market maker on the exchange. At that point, they have the ability to determine which products they choose to quote. That can be on the proprietary index side, the ETF or single name equity option side. But once they do take an appointment, as we refer to it, in an underlier, they have an obligation to quote a specific number of the strikes and expiries within that underlier. So yeah, in a nutshell, that's the situation.
Great explanation. And I think a lot of our users here are interested in particular educational topics, like understanding what market makers. Another person asked about leaps. Can you tell us what a leap is and how you might use that and how that differs from a normal option?
Sure. So leaps are effectively longer dated equity options. So they go out a number of years. So what you'll find is that there are expiration cycles that are specific to each underlier, and there are very specific considerations around those expiration cycles and the months and expiries that are active at any given time. And there are also considerations that come into play for those longer dated leap considerations that offer exposure to options going out a number of years rather than just inter-month over the course of any given year.
Yeah, great explanation. And there are a lot of questions coming in educational nature. And I just want to mention, that the Moomoo app has over 200 courses on various educational topics around finance and trading. We have a paper trading simulator where you can trade for free. We have an options calculator that gives you an idea of the sensitivity of an options to price and rates and other things. And so wanted to ask you as well, obviously we have the collaboration with Cboe, and this adds a whole nother suite of products. I know I'm not going to get to everyone's question, so I do want to let everyone know where they can go. So what are some of the educational tools Cboe offers? And any thoughts on people that are kind of just getting started and want to learn a little, maybe they trade stocks, but want to learn a little bit more about options trading?
Yeah, right. It's all about informing and educating across that journey. And I think one thing that we're focused on is, as there's been growth and adoption of derivatives and options specifically, education is right at the forefront of not just it's not a top of mind consideration for us, it's a top of mind consideration for the entire industry, right? So to that end, obviously, with the growth that we've seen from the retail client segment, again, education is a significant area of focus. The Options Institute is the education arm of Cboe. They do offer a broad range of courses and tools around a variety of topics, including trading strategies, option fundamentals, specific asset classes, just to name a few. But they really aspire to provide content and a curriculum that spans the full range of investor sophistication, from the new derivatives trader all the way to a pretty seasoned veteran who has a pretty deep knowledge of derivatives and the way in which they trade.
Oh, thank you very much for that answer. And like I said, I haven't been able to get to everyone's question, but if you do have some more questions, please download the app and check out our social community where you can find Cboe's account. You can ask them additional questions, or you can always email us here at Moomoo if with any additional questions. We will also be doing, as part of our collaboration with Cboe, 6 additional webinars in this series, one every month. So stay tuned. Next month, we'll have a great webinar about index options. I really want to thank Andy for his time. It's been really eye-opening for me. I learned a lot. I hope everyone learned a lot. There'll be a survey post webinar that you can fill out and give us your feedback. Let us know what you like. Let us know what we need to improve on, or what you would like to see in these future webinars, because we really do want to cater towards you, the investor. Thank you so much, Andy, for being here.
Yeah, just the last thing I'd like to say, Justin, you guys have been a great partner to us. I want to thank you and the Moomoo team for the continued engagement and partnership. It's been fascinating to observe the growth of Moomoo in a pretty short period of time as far as getting involved in the options space. We look forward to building and expanding upon the partnership, and look forward to what the future holds. So really appreciate you giving me the opportunity to catch up. And again, looking forward to further engagement moving forward.
Likewise, thank you so much.
Excellent.
And that's
Appreciate it.
all for today, everyone. We'll hopefully see you next month.